Hey everybody, my name is Brandon from thestockstreams.com, and today I want to talk about the three stocks that I'm watching this week. Those three stocks are Alibaba Stock, ticker symbol BABA, Palantir Stock, ticker symbol PLTR, and lastly Activision Blizzard Stock, ticker symbol ATVI. So now let's get started. So the first company that I'm watching this week is Alibaba Stock. We can see here in the trading charts that ever since our top here and from our failed Ant IPO, which was stopped by the regulators, we have been in a pretty well-defined downtrend the past few months. We can see here that the chart looks to be at around this low $220 level, which seems to be a long-term support level made from the bottoms of these candles over here as well as the tops of these candles over here. However, look how we really sliced through the floor of the support level with these two candles over here. If I can zoom in a bit, we can see that from these two candles, we sliced all the way down into the 210s. I think that we are in a very precarious spot at the moment, and any whisper of bad news could send the stock down to the bottoms of these two candles down here in the 210s. Because I like Alibaba a lot and it is a core holding in my portfolio, if we do go down to the 210s, then I would happily pick up some shares to lower my basis. That said, again, it is a bit of a risky play. There are incredible international relations risks with the United States at the moment, as well as regulatory risks from back home in China that Alibaba has to maneuver around. However, if we look at the earnings report here, we see that Alibaba is growing revenues here 37% year over year, and that is an incredible growth rate for any company, and that is what I really like to see as an investor. If we take a look deeper into the details of the revenues here, we can see that when they split up revenues, we see that cloud computing, which is this line on the earnings report here, we see that cloud computing is growing at a 50% rate year over year, which shows great diversification of revenue streams for Baba. Also, just to talk quickly about costs here, we can see that once we look at costs, total costs and operating expenses are only growing by about 3% year over year. So again, even though we are increasing revenues by 37% year over year, we are only increasing costs by 3%. That is showing that Alibaba is working incredibly efficiently, and that if they are able to continue scaling up their operations, that they will be able to continue operating efficiently and maintaining or improving margins. This efficiency is exactly the reason why I like Alibaba a lot, and is why I've made it one of my core holdings. Also, just to talk about valuation here, Alibaba is at a 25 price to earnings ratio, while a pretty similar competitor like Amazon is at an 80 price to earnings ratio. What that's telling me is that Alibaba is currently on sale. But as always, if you see something cheap in the stock market, especially with big companies like Alibaba, there are always reasons why that is. We are in a rising interest rate environment, which affects high growth stocks and emerging market stocks like Alibaba. Alibaba also carries regulatory risks like Amazon does. However, Alibaba also carries international risks with the United States. Again, you have to decide if the pros outweighs the cons before you invest in Alibaba. But because I believe in the growth of Alibaba's business long term, and I do believe that the Chinese economy will grow impressively fast over the next few years, I am always looking to add more shares to Alibaba, and I am especially happy to add shares around the $210 to $220 level. So after talking about Alibaba and why I'm watching the stock next week, let's head on over to the next stock that I'm watching, which is Palantir. So here we are in Palantir's trading charts, and we can see that in our trading charts, we are at a pretty long-term support level around this $24 level here. We can see that this $24 level acted as support a few times in the past, here at the bottoms of these candles, this candle, and these candles over here. We can also see that this $24 level acted as resistance when it was the tops of this candle over here just about a week ago. So now that we're at the $24 level again, I'm watching Palantir now to see if we are able to break through this level upwards, where we could potentially test a $27 resistance level made from these candles over here, or if we turn it back around and test these support levels down here around a $20 to $21 level. Because the trading range from this $21 level to the $27 level is like a 25 to 30% gain, to me Palantir looks like a really nice stock to do a swing trade on, where I would be buying down here around the $21 level and holding until we get up to the $27 level, where I then have the optionality to either turn a 30% profit or hold on and let the money roll, depending on how I feel that day. That said, I do like Palantir as a long-term play as well because of their business. Palantir deals with data and data analytics, and as I've said before, data will be the new oil the next few years. The world needs data if the world wants to continue to innovate, and that is why I'm choosing to pick up a master's in data science. To find new efficiencies in processes, to identify abnormalities, all of these things save companies a lot of money, and a lot of companies will be trying to use companies like Palantir to stay ahead of their competition. This is really shown in Palantir's earnings report, where we are seeing fantastic growth in revenues year over year, with this being the most recent year ending on December 31st, 2020. This growing revenues is showing that Palantir is able to acquire companies and that companies are willing to pay to gain insights on their business through data. Actually, if we look at the gross margins here, which we can get from subtracting the cost to revenues here from the revenues to get the gross profits, we can see that our gross margins are growing from 67% last year to 78% this year, and that is absolutely phenomenal. This is a very high margin business, and that is what I like to see. However, if we keep looking at the earnings report here, we can see that the operating expenses block here is growing year over year, and that is not really what I want to see in a business. Especially take note of the growth in expenses from sales and marketing and general administrative. Both are really growing at pretty fast paces here compared to research and development. Again, I've said this plenty of times before, this is not quite what I want to see because I do not think that spending money on sales, general, and administrative is a worthy investment, as we might not see a good return on investment. And it's not really investing in our product, which is what investing in research and development would be doing. So with all that said, as always with some controversial companies like Palantir, I want to point out Palantir's actual business. Palantir does a lot of business with the United States government and has been in some controversy in the past. If you are a political individual, you may want to do some research on Palantir's government and private contracts before investing. But because this is not a political show, I'm not going to talk about them. But their business can be controversial and you may like it or you may not. But the main point is that you should always be aware of exactly what you are investing in and weigh that against your morals. So after talking about Palantir Stock, now let's head on over to the last company that I'm watching closely this week, and that company is Activision Blizzard. So the last company that I'm watching this week, and there's a company that I really like, is Activision Blizzard, the company that makes the Call of Duty franchise. We can see here that Activision is really trading in the middle of a range between the low 90s here and the 100s to 105s. We can see that we're kind of at a support level made from these candles over here and these candles over here around the $95 level, but to me that's kind of weak support. The reason why I'm watching Activision this week is I want to see if we can get back down to the low 90s, and if it does, then I might be looking to pick up some shares because I do like the company. The reason why I like Activision is because I do think that the gaming industry will grow a lot in the next few years, and I honestly do like what they have with the new Call of Duty franchise. Now, Activision does make a bunch of different games, and this will probably affirm some beliefs, but I do play video games on occasion. Nowadays, most of what I play is Call of Duty, but I also play a lot of Pokemon, but that's made from Nintendo. Just for my fellow video game nerds out there, my first Call of Duty was Call of Duty 4, and I kept playing until around Call of Duty Black Ops 2 before the series went downhill. For the past few years, Activision was really trying to ramp a lot of microtransactions and kept doing a lot of slimy corporate stuff to get its customers to pay more money, and at some point I just didn't want to buy the games anymore. But then I think last year a new Call of Duty came out and that really revived its player base. Because I was still following the gaming scene, I could still get a feel from the community's reactions and the positive sentiment. This is the main point that I want to make in the video, is that it is often a good idea to invest in what you know. No matter if you like luxury handbags, video games, or sneakers, think of the companies that makes the products that you really like and consider investing in their stocks. Oftentimes you will have a real-time sentiment indicator for those companies that will give you an idea if the companies are making their customers happy or mad, which could definitely affect the revenues of their business. So speaking of revenues here, if we take a look at Activision's earnings report, we see that Activision is growing total net revenues really nicely year over year. This is like a 21% increase. However, if we look at the costs and expense block here, we see that the total costs and expenses are also increasing year over year. If we look down at the operating income, we see that even though we are increasing our costs and expenses year over year, we are increasing our operating income by about 33% year over year. But now something interesting, if we look down at our net income here, we see that even though we are increasing our revenues by about 21% and we are increasing our operating income by about 33% year over year, we are actually dropping net income by about 3% year over year. That said, if we look closer and do some investigation, we can see that it was mostly because we got some tax benefit last year, which really inflated our net income last year. So because we didn't have to pay any taxes last year, that increased our net income. So compared to this year, we look like we're dropping net income this year, but that's not really the case. So because the drop in net income can likely be explained from the tax thing, I'm not too worried about the drop in net income year over year. So those were the 3 stocks that I'm watching this week. Let me know what you thought about it in the comment section down below. If you have any questions or if you caught any mistakes, also drop me a comment down below. If you liked the video, please like the video. If you haven't subscribed yet, please subscribe. And as always, thanks for watching and I hope you have a great day.